Are you ready? Are you ready? Are you ready? Let's go.
Welcome to Unpacking the Home Advantage. My podcast is to help you understand the mortgage loan side through my experience and knowledge. My name is Paige Ashby. Do you really understand credit? Want to know how to get your scores in the 800s so that you can have the advantage to get the best rate in loan program? Let's get unpacking. Understanding your credit report. The types of credit are revolving accounts, which are credit cards, and installment loans, which are mortgage loans and auto loans. There are factors that affect your credit ratings. The first one is payment history. That counts for about 35%. It's pretty simple. Pay your bills on time. Now, I know you guys have a busy life and you're busy with kids, you're busy with your job. So the best thing to do is put everything on auto pay. And then you don't have to worry. You don't have to have any miscommunication with your spouse. So all the payments will be taken out when it's needed. The second factor is amounts owed. That's about 30%. It indicates on how much you owe on a loan as well as the credit utilization rate on your lines of credit. Keeping your utilization rate below 30% can benefit your credit. Now, credit history, that's about 15%. The longer you've had credit accounts in good standing, the better. So it could be worthwhile keeping old credit card accounts open even if you don't use them. I would just set them aside and leave them open as long as you can. The fourth thing is credit mix, which is about 10%. Is 10% of your score worth it? It can make a big difference. For example, if you've only had installment loans such as student loans or auto loans, opening a credit card can improve your credit mix. This doesn't mean you open it solely just for this purpose. I mean, if you have to open a credit card, do so, but do not open 3 or 4 or 5 of them at the same time. That will take your score down. Now, new credit is about 10%. Whenever you apply for a new loan or credit line, a hard inquiry goes on your credit report, and it can temporarily lower your score, and an increase of those activities can make you look risky for the lenders. So you don't want to open 3 or 4 new credit at the same time. So be very mindful of that. Now, the last thing I want to go over on the credit factor is negative credit. These are the items that have late or missed payments, collections, credit. These are the items that have late payments or missed payments, collections, charge-offs, bankruptcies, foreclosures, and repossessions. Before you try to pay them off or try to settle with them or dispute, you must pay attention to how old these debts are. If the debts are older than 7 years, it could actually hurt you. Now, when you try to call them and reactivate them, then they have the right to report it. So that's how it's going to hurt you because they're reporting negative history or negative marks on your credit. Now, in the lending world, depends on what program you're going with, you are required to pay off collections totaling more than $2,000. VAs are a little bit more lenient on charge-offs. They don't even make you pay some of them off, so that's a good thing. The last information that I want to go over that I've seen bring your credit score down pretty quick is entering those debt consolidation programs. These people will tell you that you have to be late on your debts in order for them to negotiate for you. So it makes sense. Why would they negotiate for you if you don't have any late payments? So that will hurt you. But if you already have late payments, then they can help you if you have a year or two to work with them to better your credit. Now, I like to go over which credit site gives you the closest scores to a mortgage pool. A mortgage pool is a hard pull. I like to use Experian.com. They monitor your credit, but they also give you a free credit score. The most popular that I've heard is, of course, Credit Karma, which is completely off. They're about 50 to 80 points higher than a mortgage pool. So you want to be careful on using their credit score. Some ways that you can build your credit is opening your own credit card or becoming an authorized user on someone else's credit card or requesting for a credit limit. Credit scores are based on how you manage your credit score in the past. The last thing I want to mention is that if you're not having any credit checks, then I highly recommend you freezing your credit. This will also stop from any soft pulls. When I did this, I noticed that the solicitation mailers for all the pre-approvals have definitely slowed down for me, but I mainly freeze my credit for fraud purposes. Now, you can also go to optoutprescreen.com to stop any credit pull triggers. You would check the 5-year option. A trigger credit pull means there are some people that buys trigger leads. Now, these can be credit pulls from car loans, credit cards, or even mortgage pulls. But any kind of credit pulls, they will get your information and call you up and bug the heck out of you. So definitely go to optoutprescreen.com and it will slow down tremendously on this. Most of my clients, I'll do it with them or I would suggest that, and they'll do it right away. And I usually give it a couple days before I pull their credit. This will help slow down all the other solicitations. So I hope all this information has helped. If you have enjoyed this information, please make sure you follow. And if you know of anyone that may benefit from this, please share. More episodes to come. As an active mortgage broker and a mentor, if you have any questions or need a pre-qualification, you can reach me through LinkedIn, Paige Ashby Lending, and my other contact infos are listed below in my episodes. Thank you for being part of Unpacking the Home Advantage.